Hello, welcome to the Asian Wall Street Journal on Air. I'm Tam Makareg in Singapore. Starting Monday, investors will be trying their luck, hoping to get a piece of China's biggest ever privatization, China Telecom. It's looking to raise some $3 billion through listings in Hong Kong and New York. The offer shouldn't have any trouble at all finding takers. It's a rare chance, especially for foreigners, to buy into China's mobile phone business, a market that's still small but set to boom. So no surprise, China Telecom shares are likely to carry a premium, but analysts say they're worth it. ABN's Phyllis Fang reports.
Recent studies show explosive growth in China's mobile phone market. Over the next 5 years, they could be up to 45 million users, making it the world's third largest cellular market. But investing in this booming sector hasn't been possible, at least not until now.
China Telecom is a unique opportunity for foreign investors to invest in the telecommunications sector in China, as this is the first and only one, according to them, that has exposure to the China mobile telecommunication.
The company has two mobile phone businesses, one in southern China's Guangdong province, the other in Zhejiang, the province that borders the booming city of Shanghai. Together, they have over 3 million subscribers and control 98% of the markets they operate in. But for this rare buy, investors are being charged a bit more. The shares are being offered at between $1.23 and $1.63, making the company's price-earning ratio between 25 and 32 times projected 1998 earnings. That's pricey compared with other regional telecoms. Analysts say price and valuation are major concerns for investors, but they note that China Telecom operates in a near-monopoly environment. And it's also a red chip, a Hong Kong incorporated company with strong Chinese backing. And compared with other red chips, its PE is about right.
If you compare it to other mobile operators, it's probably expensive. But if you compare it to red chip stocks, which it is, I think, given the parentage, then it's probably fair.
But the real appeal lies not in China Telecom's current assets, but in future ones, which is why many investors are willing to pay a bit more.
Premium is for an expectation that the parent will be injecting more of these cellular operation into the company. And of course, because MPT has 97% of the market, or a tremendous amount of the market share, and so many other provincial operation that they can inject, it's very easy for them to inject any of these in there and make the projection happen.
Average net profit growth over the next 5 years is expected to be 19%, healthy but down from its explosive growth 3 years ago. Margins are also shrinking, and some investors have voiced concerns about the company's future subscriber base, which is likely to include more individuals and fewer businesses.
They have to create more users, and therefore you're going to have to go down market, more down market. And so that means your average usage and sort of call usage as well is gonna fall. That's just the nature of the business.
After adding up the pros and cons, China Telecom still looks expensive, but there seems to be no shortage of buyers. Already the hot demand has pushed up the price range for the shares, and analysts say investors would be willing to pay even more for a piece of the action in the China Telecom market. Phyllis Fang, Asia Business News, Hong Kong.